bank. You remember when you had that as a kid? So put the money in there. Well, having equity in your home could serve as a piggy bank. And that is actually called a second loan or HELOC, a piggyback loan, because it's added to the second mortgage. As you can see right here on that side, piggyback HELOC. I want to educate you on the process, understanding what a refinance is, how much you can take out, and just some general information. First, if you've had a forbearance, know that you have to be out of the forbearance or at least be making payments for at least 3 months in order to be considered for refinance. Okay, so keep that in mind. Reasons for refinancing. Those are the following, and you get to see where do I fit in there. Most people are not going to be lowering their mortgage payments with a refinance because rates are higher than most people have right now that you have. Lower interest rates. You probably have a much better interest rate than what the rates are right now. But those are some of the reasons sometimes people do refinance. Even if you don't refinance now, when rates get better in the future, hopefully, spring, elections, who knows, all that gets impacted. And please follow me because I do provide updates on social media. Lower interest rates could be a reason for refinancing. Changing from an adjustable rate to a fixed, I don't think you have one. That's not really going to apply to you. Shorten the term of the loan. So let's say you have a 30-year mortgage right now and you want to lower it in 15 years because you do intend to keep this house for a while and you want to lower the amount of interest you pay over the life of the loan. So you can refinance into a 20-year, a 15-year, and save on interest. Most people right now are refinancing or doing line of credits to take the equity in their home for debt consolidation, improvements. I wouldn't buy necessarily a car with it, but you get to check your situation. So you get to choose which reason why you need to refinance, and we can discuss that together. The types of refinance. You have a rate and term refinance. Rate and term refinance is when we take the balance of your mortgage right now, and then we will be refinancing that balance. Usually that will be with that first reason, which is to lower the payment. Cash out refinance is when you're taking the equity out of your home, meaning the house is worth a certain amount. You only owe this amount. The difference is the equity. There's a calculation to find out how much you can access in the equity of your home. When you sell the property, minus agent commission and all the expenses to sell it, that's how much you'll be getting. Refinance, I'm going to explain that. A cash in refinance. So let's say you are receiving a bonus or you sold something, you have access to money that you want to go ahead and put on the balance of your mortgage so you can reduce your payment. There are different ways of going about that. I call it a recasting feature. So you may want to check with the servicing company that you can do a recasting if that's your situation for cash in refinance. Renovation financing is another big one. Right now, instead of selling your house, you may want to go ahead and make some upgrades to the home with the equity in the house and a contractor bid. We can go ahead and do a renovation financing. So those are some types of refinances. All right. So some few mortgage terms. Principal interest. Your mortgage includes the principal, the interest, the escrow, which are your taxes, your insurance, homeowner association, which you usually pay separate, and then mortgage insurance. That's another reason sometimes people actually refinance. With homes being higher in value, a lot of people have been able to refinance into a new loan where they're removing that PMI, that mortgage insurance. So that's another thing to keep in mind. Closing costs. So you still have appraisal fees, you still have credit report because we still pull the credit report. Then we're also going to add in your escrow. So whatever escrow you have on your mortgage, if you're doing a full refinance on the mortgage, because we can't automatically transfer it, we'll have to set up a new escrow account. Loan discount rates sometimes have discount points associated with them, meaning the cost to get that interest rate. Loan origination fee, which is a fee for the lender. Title charges, so that will be your closing agent. And interest, taxes and insurance. So you should know about those. And if you don't, reach out to me and I'll definitely explain. So now before you refinance, know the reason why you need to refinance, the reasons that I gave you earlier. So start defining, and I can help you with that. get your documents, because we definitely still need your income documents, the same as when you purchase, your pay stubs, your W-2s, if you're self-employed, your tax returns. And if maybe you were W-2 before and now you have a business and you're not reporting as much to the IRS, I do have an option for bank statements. So based on how much you're depositing or receiving income in your bank statements for your business. Before you refinance, there are a few things to keep in mind. Definitely, credit is being looked at. We need to know the value of the home and how long you intend to stay in that home, so we can have an idea, is it worth refinancing or should you just stay put with what you have? If you don't know the value of your home, and you probably are receiving this information from my home bus service that I signed you up for free, so you have an idea of how much your home is worth. Now, that's not an appraisal. Based on the area, how much the house could be worth. You can go on Redfin, you can Zillow, and different sites. Those are still estimates of what your home could be worth. An appraisal is usually done. Sometimes we actually have an option for an automated value. An appraisal is the key to when you do refinance. How much can you take out on a refinance or on a standalone second lien? So a refinance is going to be, we take your current mortgage and we're going to do a whole new loan. So the one that you have right now is canceled. We have one new loan. That loan is going to be based on the new interest rate. You can maximum do 80% if you're going to take some cash from this property. So when we usually do a refinance cash out or a line of credits, the maximum combined loan to value, what the house is worth, and I'm going to go to that calculation right here. We're going to go take how much is the house worth. We're going to multiply by 80%. From that 80%, assume 450 is just the value, times 80% is $360,000. So take the value of your home times 80%. How much is that? From that amount, we're going to deduct the balance on your first mortgage. Assuming it's 250, we take 360 minus 250, we have $110,000 to work with. You should be able to access about $110,000. Depending on your credit score, depending on your situation, we may have to go lower. You have to qualify for that payment, right? This is not just free money that you access. Even if you have access to that 110, we have to make sure you qualify. We do calculate your debt to income ratio. It's sometimes stricter on a line of credit than an actual refinance, because that second mortgage, that second lien, you keeping that first mortgage, you have a second one. That second one, if anything happens when you can't make payments, they're assuming you're going to make the first payment first, or if you don't make the payment, they're going to foreclose on you. So they may not get their money on the second. So it's riskier for them, which means they're usually going to charge you a higher interest rate. Something to think about and to know. This is an option for when we're doing debt consolidation for credit cards and other debts, to lower the credit cards of 22% or higher to get a lower interest rate. But you still have to qualify with that payment. Some line of credits will actually not allow you to qualify with us assuming that you're going to be paying off the debt. So let's say you come to me and say, Kristel, I have credit cards, I have personal loans that I took out thinking I'll be able to pay them off, and now I can't. Sometimes they actually want you to be able to qualify with your current debt. Let's say that sums to $500 plus the second mortgage that you're going to get. So your debt to income ratio is getting really tight. We'll have to talk about this to make sure this is the right program, or go to one that allows us to assume that you're going to be paying off the debt, and at closing, we need to make sure they are paid off. There are different terms available for investment properties can also get a line of credit. And I want to explain a loan versus a HELOC. A second mortgage is going to be a loan, could be a loan like your first, where you're paying principal and interest and you're getting that payment up front. You are paying $500, and that's how much you're paying for the term. That could be for 10 years, 15 years, whatever the term is. A HELOC is like a credit card. Whatever you use, there's a payment that's going to be associated with that, and you can draw back on it. It's very important to know the terms of your line of credit, of your second mortgage, your second lien. It's not always all the same like a 30-year mortgage. So be very careful, because sometimes if you're doing a 30-year For instance, the payment is calculated on 30 years, but the loan itself is only 15 years, meaning in 15 years, that payment's balloon. I do not expect you to remember all this. I just want you to have a little bit of information, awareness, so we can discuss this and have clarity by the time we're done connecting whether or not this is worth for you to do. So again, you want to know the reason why you're refinancing. Most people right now, with the new year coming, the holiday, they want to access the equity. They want to go ahead and start the new year with less debts because right now it's a struggle. So I want to also share with you a little bit of calculation here. I'm not saying those are my rates. Those are just Googling average home equity loans, right? You can see the rates vary. It can go from 8 to 10. We're going to take, let's say, the lowest, 8.6. Let's assume that 110, 8.6, calculate based on 30-year, it's $854. Remember when I said that qualification is still there? We will still have to qualify you. But the rate can also be, let's say the worst one, 12.2, according to this. Calculation, that's $1,100. Let's assume it's 50. That's changed. It's $522. Use my calculator on my webpage and go under mortgage payment and plug in what information that you and I will be discussing so you have an idea of what your terms are. Educational of line of credits, HELOCs, and reach out to me. Let's set up a time to see if it's worth it for you now, or even if it's not now, let's start your education and understanding of refinance, line of credit, so that when you are ready to pull the trigger, we would have already started to connect and it makes sense for you. Thank you so much.